This is your Swap Hunt Daily News for March 8, 2026. Bitcoin ETFs just saw their worst single-day outflow in 3 weeks, and on-chain data shows whales selling directly into retail buying pressure. Markets are sitting deep in extreme fear today, with sentiment unchanged from yesterday and down from a week ago. The total crypto market cap slipped overnight as broad selling pressure continued across major assets. Bitcoin is trading below its 20-day moving average in neutral regime territory, while altcoins are underperforming across the board. The divergence between whale activity and retail buying has analysts watching closely for the next directional move. Bitcoin ETFs in the United States recorded their worst single-day outflow in nearly 3 weeks on Friday, with $349 million pulled across all 11 products. The timing was striking. According to Sentiment, large holders had been accumulating Bitcoin throughout late February and early March, while prices ranged sideways. When Bitcoin crossed above 74,000, those same whales began offloading. By Friday, approximately 66% of their accumulated positions had been sold. The counterparty on the other side, retail, smaller wallets, those holding less than 1/100th of a Bitcoin, added to their positions as prices fell. Sentiment flagged this exact divergence as historically bearish. When smart money exits into retail demand, it typically signals that the market hasn't found a genuine bottom. The Fear and Greed Index dropped 6 points on Saturday, landing at 12, deep in extreme fear territory. Some analysts pointed to a key support zone around 67 to 68,000 as critical. Losing that level could open the door to revisiting prior lows before any meaningful recovery attempt. Economist Timothy Peterson offered a counterpoint, citing a near-certain probability that Bitcoin holds above 60,000 based on every prior cycle. But with ETF flows turning negative and whales in distribution mode, the burden of proof sits firmly with the bulls. On-chain analyst Boris has flagged a persistent and troubling signal in Bitcoin's long-term holder data. The long-term holder active supply ratio has been climbing consistently, indicating that coins dormant for 6 months or more are being moved and sold into the market. This pattern has historically preceded extended downturns. The typical playbook works like this. Long-term holders distribute into rising prices and weakening demand. The market then enters a sideways phase, what Boris calls a liquidity illusion, before the next leg lower materializes. What makes this read particularly notable is the scale of the move already in progress. Since LTH activity accelerated, Bitcoin dropped from around 95,000 to near 60,000. Despite that significant drawdown, the LTH supply ratio never reversed. It kept rising. That suggests distribution hasn't concluded. The cohort that accumulated through the previous cycle is still offloading. Boris's projection points to further downward pressure by year-end if this pattern holds. It's worth noting this is on-chain analysis, not a price target, but the signal is consistent with what ETF flow data and whale behavior are also showing. Multiple data streams are telling the same story. A group of U.S. lawmakers is pushing back against a proposed temporary ban on a central bank digital currency in the United States, arguing it doesn't go far enough. Their position: any restriction must be permanent. The legislators framed a digital dollar as inherently anti-American, citing concerns around centralized monetary control, financial privacy, and civil liberties. A temporary ban, they argued, leaves the door open for a future administration to reverse course. The demand for a permanent prohibition reflects a broader and growing coalition of skeptics who view CBDCs not just as a financial instrument, but as an infrastructure for government surveillance of spending. This debate sits at an interesting intersection for the crypto industry. On one hand, a legislated block on a U.S. CBDC removes a potential competitor to decentralized alternatives. On the other hand, the same lawmakers pushing this ban often hold cautious or restrictive views on crypto broadly. What's significant here is the legislative momentum. Moving from debate to formal demand for a permanent block signals that CBDC opposition has become a defined political position, not just background noise. The outcome of this push will shape how digital currency policy in the U.S. develops heading into the next budget cycle. While most of the crypto market is grinding lower, Solana is flashing a standout signal in payment infrastructure. Messari's latest State of Solana Payments report documents a 755% surge in total payment volume on the network, a figure that puts Solana ahead of both Ethereum and BNB chain in payment throughput. The report attributes this growth to Solana's architectural edge. The network unifies messaging and settlement into a single atomic operation, cutting out intermediaries and settling transactions in milliseconds. For global payment use cases, that efficiency gap versus legacy financial rails is significant. Institutional interest is also building. Solana spot ETFs recorded nearly 448,000 SOL in 7-day inflows, roughly $40 million, led by Bitwise's BSOL fund. That institutional layer on top of growing organic user activity is a combination that doesn't show up often during bearish macro conditions. The broader context matters here. Crypto sentiment is at extreme fear. Bitcoin is underperforming, and yet Solana is posting adoption metrics that point in the opposite direction. Whether this translates into sustained price strength depends on broader market conditions. But the user and institutional data is telling a genuinely different story from the rest of the market right now. Large XRP holders continued moving significant volumes off Binance throughout February and into early March, according to on-chain data analyzed by market observer Amr Taha. The multi-exchange's daily whales net flow metric tracked roughly 44 million XRP leaving the exchange over the period, with one day in early March seeing approximately 30 million tokens exit Binance wallets in a single session. These are not small movements. Negative net flow readings from a major exchange typically indicate one of two things. Either whales are transferring to cold storage for long-term holding, or they're moving to other venues to sell. Taha's red leans toward accumulation, the interpretation that large investors are pulling XRP off exchanges to hold rather than to sell, which would reduce available supply. Historically, sustained exchange outflows at this scale have preceded positive price moves in XRP, though timing is always uncertain. Current spot XRP ETF inflows in the US remain modest and insufficient to drive immediate price action on their own. What makes the Binance outflow data notable is its consistency across multiple days rather than being a one-off event. Whether this is strategic positioning ahead of an anticipated move or simply institutional cold storage reallocation, the supply leaving active trading venues is a dynamic worth tracking. Crypto analyst Chiefy has drawn a detailed parallel between current Bitcoin price action and the 2022 bear market sequence. The pattern he identified goes like this: a significant drop followed by a bear trap recovery, then a bull trap rally before the actual bottom. In 2022, Bitcoin dropped to 18,000, recovered briefly, rallied to 21,000 in what looked like confirmation, then fell again. Chiefy sees the same structure playing out now. The drop to 60,000 in February followed by a recovery towards 74,000 could be the bull trap. If that read is correct, the next significant low could materialize around 50,000. Separately, a longer historical perspective suggests Bitcoin's bear cycles have become progressively less severe. The 2011 crash wiped out 93% from peak. Each subsequent cycle showed smaller percentage drawdowns, 87, 84, 78%. Applying that trend to the current cycle, with the 2025 peak near 126,000, a 70% drawdown would place a worst-case floor around 37,000. It's a wide range from 50,000 in the near-term scenario to 37,000 in the more extreme case. Neither is a forecast. They're structural observations based on historical patterns. But in an environment where sentiment is already at extreme fear and whale distribution is ongoing, these frameworks are getting more attention from traders trying to locate a bottom. That's your daily crypto roundup for March 8th. If this kept you informed, hit subscribe on Swap Hunt HQ here on YouTube and follow Swap Hunt on X for real-time market alerts. See you tomorrow.